Hi, welcome to this brief tutorial on profitability ratio analysis. So an introduction to performance analysis using financial statements. Okay, this is what we're going to cover. We're going to talk about four particular ratios. They are the profit margin, the gross profit margin, the return on assets, and the return on equity. And they all involve profitability of the business and performance. For each ratio, we're going to go through the formula and a quick example. We're going to talk about where we find the required data inputs for the ratio. We're going to talk about how to interpret the specific result, as well as how to interpret changes in the result, and that's what's most important, is analysing changes over time. And then we're going to talk about particular drawbacks of each ratio. In the conclusion, it's important that you stick to the end of the lecture, because this conclusion is important. It talks about different ways to conduct ratio analysis, and it talks about key ideas to consider with all your ratio analysis. And then finally, we just offer further support and also ask for your feedback. Okay, so let's get cracking. The profit margin. The profit margin tells us how much profit is generated from sales. It's specifically the percentage of sales revenue that ends up on the bottom line as profit. And it's a great indicator of cost control and or pricing power of the business. Here's the formula. The profit margin is simply net income divided by sales revenue. And here's an example. So I'll leave that for a couple of seconds. You can have a look at the numbers, and it works out to be 23.7% for the profit margin given those figures. Okay, where do we find the required inputs? Well, net income simply comes from the bottom line of the income statement, and sales revenue is the top line from the income statement. Alright, how do you interpret the results? In our example, we had a figure of 23.7, and this simply means that 23.7 of our sales revenue ended up as profit. Or in other words, 100 minus 23.7, or 1 minus 23.7%, means that 76.3% of our sales revenue went to expenses. Alright, how to interpret changes in the results. And I'll keep reminding you that you've got to analyse changes in particular ratios to really get the best benefit. Firstly, arithmetically, it means that expenses have changed in relation to sales. And this could mean that management is effective with their cost control, or ineffective if expenses have increased. There could be economies of scale that are being utilised, so you could have a change in sales revenue based on scale without a resulting change in expenses. And there also could be a change in the bargaining position along the supply chain. So this could mean that if you have a strong bargaining position along the supply chain, you could drive down your expenses. Or if you have a weak position, you may be a price taker in a lot of your costs, and expenses could be increasing. The other side of the equation is that sales revenue could have changed in relation to expenses. This could be a change in pricing power, so you have a strong bargaining position with your consumers, and you can increase prices without a corresponding increase in expenses. This is always a really good position of a business if your customers value your product, and you can continually charge higher and higher prices and still have the same level of sales. It's a very good position for a business. There's also the general factor of a change in the state of the economy and aggregate demand. So simply you could do very little, but a booming economy could boost your sales revenue, boost your sales, and keep your expenses quite low, or without a resulting increase in expenses. And there's also market competitive position pressures. So that means if there are new entrants to the market, or you have strong competitors, and possibly they drive down the price in the market, you may have to follow suit, and that'll decrease your sales revenue. Alternatively, this has to do with pricing, though, is linked, but not completely linked. But if you've got a strong position in the market, and there are a few competitors, then you might be able to increase the sales revenue without a corresponding increase in expenses. Okay, drawbacks of the ratio. You'll find that the profit margin is very industry specific. So some industries have naturally higher or naturally lower profit margins than other industries. So it's sometimes a bit difficult to compare businesses based on profit margin across industries. And secondly, the profit margin can also be affected by strategy, and the ratio doesn't take account for that. So an example that I've used before is that would you rather a business that had a 40% profit margin on $100 revenue, or a business that had a 10% profit margin on $1 billion in sales revenue? So it doesn't take account for scale, and often a strategy can lead to an increase in scale, and you wouldn't always see the benefits in the profit margin. Okay, the next ratio we'll look at is the gross profit margin, and this is a very important ratio for resellers and manufacturers. So particular businesses that hold inventory, and specifically, it's the profit between the cost of inventory and the sales price, or in other words, how much sales revenue is left to cover profit and all other expenses. In other words, it's the difference between the sales revenue and the cost of your inventory expressed as a percentage. So here's the formula. You have sales revenue minus cost of goods sold, and then you divide it completely by sales revenue. And there's an example there with a few figures if you want to punch them in and see if you can work it out. But what it means and how, actually, first of all, let's get to this first. Take it slowly. Where do we find the required inputs? The sales revenue is simply from the income statement, and the cost of goods sold is from the income statement as well. Cost of goods sold is also known as cost of revenue or cost of sales. It's simply the amount you pay for your inventory costs. So hypothetically, if you're running a business that sells widgets and you spend $70 to purchase a widget that you're going to later resell, so you pay your suppliers $70 for that widget, then your cost of goods sold would be $70 when you sell that widget. And ideally, you'd sell it for your sales revenue would be higher than your cost of goods sold. So let's go back a bit. So your cost of goods sold would be 1,846. That's what you pay for your widgets, and what you sell your widgets for is 5,777. And if you calculate that formula, then that will leave your gross profit margin at 68.04. All right, let's go back forward again. Okie dokie, let's go. Alrighty, how do we interpret the results? So let's start at the bottom first. The 68.04 result simply means that's the sales revenue that's remaining to meet our expenses and our required profit, our other expenses. Or in other words, 100% minus 68.04 simply means that 31.96% of our sales revenue went to purchase or create our inventory. So it went to purchase our widgets or create our widgets. All right, how to interpret a change in the result? One side of the equation is that sales revenue has changed in relation to our cost of goods sold or our cost of inventory. This could be again. Okay, I'll mention this now. As I was doing these slides, I noticed that there's a lot of repetition in some of these reasons and some of these interpretations. This comes down to the fact that all of these ratios are profitability ratios. And because they're all focusing on one aspect of the business, profitability, you'll find that quite a few of the reasons kind of revolve around the same ideas. And you'll find that each individual ratio serves a particular purpose or has a particular angle, but they all revolve around profitability. So there are some similar reasonings behind them. So the first one we've got here is a change in the pricing power. So your bargaining position with consumers. Again, if people value your product or value the business's product and you're able to charge a higher price, then sales revenue can increase without a cost of inventory. An example is that like Apple. Apple may pay the same for a tablet that Samsung might or Xiaomi might, but people who purchase Apple products, like myself, we really value them, and we're willing to pay a premium price. So Apple has pricing power and good bargaining position with the Apple fanboys and fangirls. Also, there's a change in product or aggregate demand without a flow through the supply chain yet. So if a particular business has a spike in demand for their particular product, then they may get an increase in sales revenue through a boost in sales or a boost in sales price. Normally, over time, if there's a boost in aggregate demand, this will flow right through the supply chain. So if the business boosts its prices, you might find that the suppliers end up boosting their prices as well. But until the suppliers boost their prices, then a spike in aggregate demand without a corresponding increase in those prices from those suppliers will lead to a improved gross profit margin. Once again, there are market competitive positions and pressures. So if your sales revenue has changed, then there could be a change in the competitive market. Maybe an increase in competitors or a decrease in competitors, and so forth. And also, once again, a change in business strategy. So business could be discounting their products, and that could be a particular strategy, perhaps for a Black Friday deal or just a general, they want to change their position in the market, and there is no fall in their cost of goods sold. Cost of goods sold is abbreviated to COGS, capital COGS. So there could be discounting without a corresponding fall in cost of goods sold. Or cost of goods sold, alternatively, has changed in relation to sales revenue. This could have to do with power in the supply chain. The example that I always use is Walmart. Walmart has a lot of power in the supply chain, and it can drive down its cost of goods sold, its cost of inventory, because of its power. The flip side is if you have no power in the supply chain, and your suppliers might be able to increase their prices, and you have no choice, and your cost of goods sold could increase. Other simpler reasons, you may have just changed suppliers. A business may have just changed suppliers, and cost of goods sold have changed. Or there could be production efficiency. If you produce your products yourself, and you may have found a different way to produce your products, and your cost of goods sold has changed because of a different production process. All right, the final one mentioned here is a change in prices of particular commodity inputs. If you're in an industry where part of your cost of goods sold are global commodities, then you may have absolutely no influence over the commodity price. It might be a take it or leave it sort of proposition, and particular changes in commodity prices might directly impact your cost of goods sold. You have to think about it from a company like Starbucks, and they purchase coffee beans over and over again all throughout the year. So if there's a change in Arabica beans, the prices of those, or the change in coffee beans globally, then their cost of goods sold will change as those commodity inputs change. All right, the drawbacks of the ratio, once again, it's very industry specific. So you'll find that some industries have high gross profit margins, while some have very low. Secondly, it's a narrow ratio to test the overall performance and can ignore many expenses. Profitability ratios is a lot about performance, and the first slide talked about performance measures through financial statements. When you're only focusing on the inventory costs, you are ignoring many expenses throughout the business. So you may have a great gross profit margin, but if you can't control your other costs, then it may not result in a high profit at all. That you can't really tell at all from the gross profit margin. Okay, the third ratio we're looking at is the return on assets, and this is the return from the assets for those who funded the assets, or the return generated by the assets for those who funded the assets. Now, if you imagine that that every single, not imagine, but if you can go along with the fact that every single asset in a business is funded by either equity or debt, then the return on assets explains the return. All right, let's just go to the next slide for the formula. All right, you can see the inputs involved income before tax. So that's the return for the equity holders, and the other input is interest expense, and that's the return for debt holders or debt funders. So it is the return generated by the assets for those who funded the assets, either being equity holders or debt holders. It's also an insight into the success of management in the income generating asset allocation and utilization decisions. So if management is doing a good job in purchasing assets and using those assets to generate a return, then it should show up in the return on assets. When it focuses on equity holders and debt holders, both of those groups want to know how successful management is at its asset allocation and utilization. All right, so here's the formula. It's income before tax and interest expense, and that's the numerator. And then you divide that by the assets at the start of the period plus the assets at the end of the period divided by 2. So simply, it's the average assets over the period, and you divide, and that is the denominator that's dividing income before tax plus interest expense. There's a few digits which you can punch in and see if you get the same result. And the return on assets is 16.18% in that example. All right, where do we find the required inputs? Income before tax is simply from the income statement. Interest expense is also from the income statement. Assets at the start of the period is from the previous balance sheet. So that's the balance sheet that was created for last period. And assets at the end of the period is from the current balance sheet. So that's from the balance sheet from today. So if you're looking at an average, you need one from the start of the period and one from the end of the period. And since the balance sheet is a photo rather than a video, you want the balance sheet for today, for the end of the period, and the previous balance sheet for the start of the period. And how do we interpret the result? 16.18% in our example was returned from the assets. That's what the assets generated for us. Or you could say that 16.18 cents was generated for every dollar invested in the assets and is available as a return for those who funded the assets, those being the equity holders and those being the debt holders. All right, how do we interpret changes in the result? One side of the equation is profitability is changed in relation to the level of assets. In effect, if profitability is increasing in relation to the level of assets, this means management is getting more from less in regards to the assets. It's getting more bang for its buck from the available assets. In other words, management has made good asset allocation decisions in terms of revenue, and it's generating more revenue for a specific level of assets. Or it could mean that management has good cost control in relation to expenses. So it's earning same revenue, same level of assets, but expenses are decreasing, and that'll increase profitability in relation to the level of assets. And once again, this is a profitability measure. And once, as I mentioned earlier, some of the reasons carry over. So there's things like the general state of the economy, the market power with customers and also suppliers, and also the competitive position in terms of marketing and the competitive market. I think also the other side of the equation is the level of assets have changed in relation to profitability. One example is that assets may have suddenly increased if there was a recent large capital expenditure. So assets may have suddenly doubled, and the resulting profitability hasn't changed. The new assets haven't become profitable yet, and there could be a change in the level of assets from capital expenditure without a corresponding increase in profitability as yet. That's if assets are increasing. If assets are decreasing, this may mean that assets aren't being replaced or replenished at the same rate. So assets are falling quite quickly, or not quite quickly, but assets are falling without a change in profitability. And this may be as a result of a particular choice in depreciation or amortization. So depreciation and amortization policies are a choice of management or a choice of the finance department. And assets, the value of assets specifically relates to the cost of the asset or the value of the asset minus the given depreciation or amortization. So the depreciation policy does have an impact on this result. The drawbacks of the ratio, it can hide or disguise a lack of asset investment. As mentioned, a fall in the asset level of assets can increase the return on assets because you have a smaller denominator in the ratio. But it's never a good idea to let the asset base run too low. You always want some level of assets in the business. So it can hide or disguise a lack of asset investment. For instance, you wouldn't want your assets to drop down to $10 or $1. Like in theory, $100 of profit on $1 of assets is a very high return on assets, but it's not necessarily a good idea to let your assets drop to zero and have no income generating capability anymore. And as I mentioned earlier, the choice of depreciation policy can have a big effect. And this means that this can imply that the return on assets can be too easily manipulated by accounting policy. It can affect both the profitability aspect if management chooses a particular accounting policy that leads to higher profit, but specifically the choice of depreciation or amortization policy for the asset can have a big impact on the return on assets, and that is a drawback. Okay, the final ratio we're going to look at is the return on equity. This is a little similar to the return on assets, but instead of looking at the return generated for the equity holders and the debt holders, this specifically looks at the return generated for the owners of the business, and these are the equity holders or the common stockholders. It also shows an insight into the success of any leverage use when comparing to the return on assets. What you'll find is that if the return on equity is higher than the return on assets, this is an indicator that the business is successfully using borrowings. It's successfully leveraging their investments, and that's depending on your viewpoint on debt, that is a good sign. But I guess it's always a good sign that they're successfully leveraging debt, leveraging the business rather than unsuccessfully leveraging the business. All right, here's the formula. It's net income, or the bottom line, minus preference dividends. We take out preference dividends because they're not the common stockholders. They're not generally the owners of the business. It's kind of like a hybrid between debt and equity. So we take out preference dividends, and then that's the numerator, net income minus preference dividends, and we simply divide that by the average common stockholder equity over the period, which is common stockholder equity at the start of the period plus the equity at the end of the period divided by 2. And once again, there's an example. If you want to pause it and punch in a few numbers and see if you get the same result, then that's great. And in the example, we had 13.5% as the return on equity. All right, where do we find the required inputs? Net income is from the income statement. Preference dividends is also from the income statement. It's not always from the income statement. Some financial websites put it in the income statement, but you can always find it in the company investor relations section and company announcements. Common stockholder equity at the start of the period is from the previous balance sheet, and common stockholder equity at the end of the period is from the current balance sheet, and that's similar to the assets inputs from the previous ratio. All right, how do we interpret the results? Simply, our example was 13.5%, and it means that 13.5% of the equity was returned for the owners over the period, or that 13.5 cents was generated for every dollar of common stockholder funds in the business. How do we interpret changes? One side of it is profitability has changed in relation to the level of common stockholder equity, And this means that the management performance is changing in the eyes of and on behalf of the owners or the employers, or their employers, the owners being the employers of management. Because owners elect the board, and the board employs management. So since it uses net income in the figure, it incorporates all the decisions of management. So it's a big indicator. It's a strong indicator about the performance of management, and generating net income. And it has this in relation to common stockholder equity, which means it's on behalf of the common stockholders or the owners. I'm not going to repeat all the previous ones, but there are other factors that are involved: the economy, market power, competitive position, plus cost control and asset and we've added cost control and asset utilization. The other factor is that common stockholder equity is changed in relation to profitability. This could be because the level of liabilities have changed, and thus equity. Because if you know your accounting equation, equity equals assets minus liabilities. So if liabilities have changed without a corresponding change in assets, then common stockholder equity will fall. And the other factor is equity may have increased. That could be through a reduction in liabilities, or it even could be through a stock issue, or perhaps it's decreased through a stock buyback. So there could be changes in liabilities, or it could be changes in equity directly through a stock issue or a stock buyback. All right, drawbacks to the ratio. The ratio can be easily manipulated by the level of liabilities. So it can be easily manipulated by the level of liabilities. If I run through the example that if all expenses that come into the business are being placed on credit, they're all being put on a bank overdraft or a credit card or a loan, then this will increase the level of liabilities, while also decreasing the level of equity. So even with the same profit, the increased level of liabilities will decrease the level of equity, and that'll improve the return on equity, because the equity figure will be getting smaller, profitability will remain the same, and the only change is an increase in the level of liabilities, which isn't always a good sign. And there's also a heavy reliance on the net income figure. And while I don't have the skills or the time to fully explain profit manipulation and profit massaging, there always are some choices by management and some choices by the finance team that can influence the net income figure over a particular period because of accounting policy. All right, let's move on to the conclusion. The different ways to conduct ratio analysis. There's trend analysis, and this is when you look at a single ratio over different periods. This is very important when you look at how ratios change over time. That's why I included that particular section of each ratio. It was an analysis of a change in the ratio. So it's important that you look at the trend of ratios. You can also do it. You can compare particular ratios against their competitors or against other benchmarks. So that's using a single ratio against different companies rather than the company itself. Or finally, you can look at multiple ratios at once. This is something I use. You can look at perhaps 3 or 4 different ratios and paint a bit of a picture using those different results across a variety of ratios. And again, you can do that using multiple ratios. You can do trends, and you can also do comparisons to benchmarks. Key ideas with all ratio analysis is the calculation is the easy part. It's termed ratio analysis, not ratio calculation. So while it's important to know the formulas, you shouldn't just simply rely on the result. You should use the results as a basis for inquiry. So the ratios are symptoms of a particular concern, and you should use the ratio results not as the diagnosis or the prognosis, but you should take them on as symptoms, and then from there take further investigation to find out what the particular diagnosis is. Secondly, ratio analysis is not a one-off task. You can't do it once and then just put a report in the bottom drawer and never look at it again. Ratio analysis requires an ongoing system. So every quarter or every 6 months or every year, you should repeat the process and see how things have changed. And again, use that trend analysis over time. But you should have an ongoing, a set system, a regular routine. And finally, you need not use every ratio under the sun every time. Over time, as you do this more and more, you'll have particular favor ratios. You can do your own tests and see how you go, but you don't have to use perhaps all 4 of these profitability ratios every single time. You can, hopefully from the explanation, you'll see some of the differences between them, and through your own practice, you'll see which ones are best suited to your own investing style or your particular business, and from there you can pick and choose which ones suit you best. But you don't necessarily have to use every single ratio. Not only profitability, but leverage ratios and efficiency ratios and so forth. You don't have to have 101 ratios every single quarter. Alrighty, congratulations, we're done. If you need any help or clarification on anything you've just seen or come across, get in touch. I'm more than happy to help. I love this online teaching stuff, and I'm more than happy to help if you get in touch. And secondly, feedback is always welcome. I would like to be able to offer lessons that you're looking for, rather than telling you what you should learn. So I only know what you want if you get in touch and tell me what you like or what you don't like, or what you need help with, or what you'd like to learn about. So feedback is definitely always welcome. Thanks very much for your time, and have a lovely day.